Good afternoon, everybody. Good morning, Jerry out west. Um, we're we're having a little bit of a meeting of the minds when it comes to talking about nuances in the buy side recruiting process, different kinds of case studies, different things you should know or things that you can know about funds. We're going to cover a lot of ground today. And probably the best person to kick it off to share some initial findings and thoughts about the buy side recruiting process. We have none other than Mr. Richard Toad himself. Jerry, why don't you kick it off?
Hey, thanks for having me, Andrew. A real honor. I've been following you guys for a long time, and just finally earned my spot to share my take with you during a conversation. Look forward to it.
I have kind of my slate of things I'd like to talk about, but I
Yeah,
know it'll be building on yours.
yeah, man. I like to always be critical of people. I feel my passion really my real passion lies in setting people straight in terms of like the wrong attitude or wrong perception of what it takes to first break in and more importantly succeed in this highly competitive and highly financially lucrative and exclusive profession. So I will start by the wrong perceptions, like the problems people have with the search in general. And first off, let's get the easy low hanging fruit out of the way. Like you gotta do the work. Like there's if you have no hunger, if you have no ethic, that's no bueno. Like the good thing is most of these people that fall into this bucket, they don't have a chance at all to even well they might have some conversation, but there's no way you will get a job. Like you will ever get a seat in this profession, and that's good for the profession. And frankly, that's good for you because if you get a seat, you will be blown out very quickly because you add no value. So attitudes like expecting info to come to them, right? We know that finance forum. There's a hedge fund section. Most of the time, people are just asking questions like, "Hey, how do I get this something that's easily Googleable?" And nowadays, how so easily asking ChatGPT and Perplexity, right? You're not gonna make it. Like and last minute, like, oh hey, I go to a very good college. I have this hedge fund interview tomorrow. They asked me to pitch a stock. So anyone help me how to pitch a stock for tomorrow? Like that, not gonna make it. Right, wing it, not gonna make it. Second is I think you gotta understand supply and demand. There's a lot of chatter about who's in vogue in terms of investment style at different parts of the market. Uh, like good, just keep that in mind. Like good seats are going to be hard to come by. Like top, whether it's say what you want. People nowadays dunk on like the elite tiger style single managers. I argue they still will get the at least the best candidate on paper. And that's the same thing with like people asking about, hey, how do I get into the I don't know how to say top 5%, so I will say decile, like how to get into a top decile pod pod seats, right? First of all, they rarely open up. Second of all, they're gonna expect to be more competitive. So what that means for you is you need to loosen up your search parameter. And the third piece is very controversial. Is I wasn't a very experienced investor, so and that's why I say it is because like most people I understand this is a profession about money, but I argue don't focus solely on pay. Right, instead as an entrepreneur today, I think about two things. One, value creation. What is value creation in hedge fund land? Can you make money? And value capture, that's a little bit more subjective, especially in a single manager uh, side of things where the CIO has discretion on how much they pay you despite you getting actual names into the book and versus a multi-manager, which is relatively less political and more formulaic. But most of the big money that you're all salivating, you get that at the more later stages of your career. That's when you become a risk taker for the firm. So I think it's most important to find a good seat with a good PM, hopefully has good emotional control and can coach, and a shop that has aligned investment style. Because that way you're optimizing for a smoother pathway to generating alpha, adding value to the firm over time. If you just add value so consistently, like people want to keep you, so they will take care of you via the thing that you like, which is money. And that's the same thing with on that topic. It's the same thing with trend surfing, right? You see on finance forum, a lot of people ask me in my monthly Q&A as well, which is like, you my recommendation is find a style you believe in, that you're comfortable operating in for the rest of your career. Uh, Instead of saying, oh my God, like multi-managers, like it's working. It it's been working, right? And so there all these people will, oh, hey, how do I get into this? I don't know what it entails. I don't know what pod like flow pod style investing is, but I want to get it because it seems that everybody's getting in. Uh, it's the same thing with stock investing in general. If everybody's getting in, chances are probabilistically it's probably more peak than trough. And so like bending yourself to please a style that doesn't resonate with you, it will only end badly for you because the place you join will not change the way they skin the cat like for you. I learned that myself. Uh, Worst case, look, I mean, worst case, if you believe in something that's secularly, like stylistically, it's secularly declining, find something that's close to it. Worst case, it's okay to not pursue the profession. That might not tie with the narrative we try to do as a business, but no style always works. Market regime ebbs and flows. Just keep that in mind. And then on the same point is um don't waste time. Like don't waste time on things that when you're not even in the seat. Like don't waste so much time on like forums, uh, like asking about compensation, asking about time to X number of net worth. Like how many year on average do you get to like X $1 million or tens of $1 million net worth perks, right? Like just because you saw a article on that rainmaker in an outlier year, right? Like that can happen to you most of the time, if not like almost all the time. It doesn't have to. The only thing that matters to you is, can you make money? You should work on your game. Like spend 95% of the time work on your game and getting your brand known. That's the networking piece. But work on your game, friend. I think Andrew probably won't disagree that that's the most important thing, right? You can't put up no money. You can't put up numbers as a performer. It doesn't matter. And then I would say last thing is just uh, don't hide behind, like don't stay within the comfort zone. And what I mean by that is don't hide behind other people's learning. And that's something I've done a lot in my career. And so what that means is, oh, instead of generating idea, instead of doing work on another name, read all the investor letters, read another investing book, listen to another podcast. There's nothing wrong. It's not the worst crime, but it's other people's learning. You can learn and you can note about your own beliefs without doing work on your without doing your own work on names, without making your own mistake. You have to take risks. You will be wrong, but you will also learn. There's no better way. And that's the thing. And then last thing, which I'm sure Andrew will touch on, which is just like uh, do your homework on the style of the funds you go join. If you have no content audience fit, one is you don't believe in the way they do it, or second is you didn't even bother understanding how they do it. And what you end up doing is you pitching a growth name to a value shop, pitching a catalyst name to a compounder shop, all that stuff. And that is a sure way to get yourself off the how to say get yourself off the short list of candidates who will get the final offer. So I'll stop here. Yeah.
Yeah, it's a great point. I think Jerry went over a lot of things that I would definitely co-sign based on my time as an investor. I think focusing on the people is very important because you're going to have ups and downs. And definitely, I know of stories of people who went for, the shiny object at one fund and became miserable human beings because of the people who were around them. But there was nothing they could say because that was where they signed to go work. They didn't do this vetting at the outset. So definitely the people that you work with are very important. Another thing I would say is when you're thinking about the investment style, and this is something we'll get into in a little bit, but finding a way to contribute to the team in a way that is compatible with their investment style is very important. There are a lot of people who have a good work ethic, they're high horsepower people, but maybe the way in which they can best contribute just misses the mark a little bit in terms of how this team does business. And when you're the newest or the most junior hire, you don't get to drive the bus and suggest a radical change in how the fund does things. Jerry, I had a question for you based on something that you said. I think you're absolutely spot on with knowing who it is that you're pitching to and understanding what they're doing. And a point that you made about how the market can ebb and flow. You want to think about where could be best for you. I think a question, it's one that I've seen come up from time to time. I'd be curious to get your take. Sometimes people are very passionate about investing on their own, like they have a personal account and they'll do whatever they can to prepare. They're very resourceful, but they may not yet be able to articulate their own investment style. And so they don't know, would they fare better in, for instance, like a multi-manager or at one of the flavors of single manager. And we know it's a game of reps, and so you want to get a lot of shots on goal. How do you help people, or what would be your advice to people who are navigating this transition where they may have an underdeveloped investment sense or investment process? Maybe they've had some early successes in their personal account, but they don't yet know what would be the right kind of organization for them. What would be your advice there?
That's a great question. I just off top of my head, I will say probably two pieces. First piece is um the information is actually out there. Well, namely, the 2 hour intro session that you and Brett have done, where you lay out the spectrum, and which is something I have done on my YouTube channel and in my course as well, is we've laid out the spectrum of styles of investing that exists in the market today. And there aren't that many. It's not overwhelming. So if you have the horsepower to diligently work on single stock ideas on a daily basis, make an effort to understand what these styles are, what kind of setups fall into those kind of situations, and look back on the things, look back on the situations you have invested in and made money or lost money, and think about what do they tend to fall into after you understand what those styles are. And that way you start to get a sense of, okay, clearly I tend to gravitate toward uh like uh, like quality name at a value price, or I tend to gravitate to requires a lot of imagination, but on the next year on an NTM basis, that stock is insanely expensive, but I know uh, the earnings will grow exponentially, and that will be your go-to whale rock type style, or a situation where, okay, this is a clearly a melting ice cube, the secularly declining business, but hey, it's trading on like 30 cents on the book value. I want to join a deep value fund that either will agitate via some sort of shareholder board of directors shareholder engagement, or I will do some sort of public shaming via a publicized shareholder letter to agitate for an asset sale. That puts you into a activist slash deep value investor. So there has to be a way where you can bucket the things that you worked on before and what do they tend to fall into. And that's one way to know what kind of investor they want to become. And the other way is to think about lifestyle. just you and that's also something you talk about in that 2 hour session, which is okay. It comes down to a few things, right? Is it do you like long short is very different from long only, not just from adding short selling. When you involve short selling into the portfolio management process, because there's a differential between long and short. Suddenly you have to worry about things like net exposure, and you have a turnover mismatch, duration mismatch between your long book and short book. All these things, is that something you want to deal with? Because I was exposed to that despite being somebody who wanted to pursue, I just want to buy something that goes up. If I can't find anything, I'll stay cash. And so like I knew I have a North Star of what I want to pursue, but for you, you have to think about, do you like shorting? Do you want to deal with being constrained into risk parameter, but what you produce is pure alpha, or versus you want to beat the benchmark and it's kind of slow and steady, it's more permanent capital, but you know your path to big money is relatively slower. And there's also no guarantee you will get to the big money like 15 years out. So all these things, it's all a trade-off, and you have to balance what part of the trade-off you don't compromise on certain things, but you can compromise on other things, and that will be another point to drive your decision as to where you ultimately want to end up in terms statistically as an investor.
Those are all great points in terms of going in clear-eyed into what the sort of setup is where you'll be working, and just understanding what are the kinds of things that are likelier to happen in one seat versus in another seat, or what the trajectory looks like. That's very important. A piece of advice that I give to people who are relatively new to the industry is, if they really are torn between one sort of seat and another sort of seat, what I'll say is, get the first seat and learn from there. And whichever seat is your first seat is going to be kind of determined by your options. And those options are going to be determined by how far you get through the process. Do you get an offer from 5 shops and you're choosing among 5, or you interviewed with 5 and you got an offer from 1, and that looks like that's where you're going to go. And some of these things, we talk in generalities about the types of firms where a person can work. One thing, and we also talked about the importance of the people. It's actually a great segue into talking about what case studies look like from hedge funds, and why they give them to people. Because everybody knows any job interview, regardless of which industry you're talking about, every job interview has some sense of, do you know something more about our firm than the average person we can find on the subway? Do you know something more about the role than someone we can find? Like, do you understand what it is? And then, of course, there's the personality. Like, do you pass what people call the airport test? You and your boss are stuck somewhere, the flight's canceled. Is this going to be an enjoyable delay together, or anything but? So that's part of it, because you're going to go through ups and downs together. But case studies from funds, I might throw a slide up here. I talk about pitches a little bit. There's a thing where, when people are pitching stocks to funds, you want to know who your audience is, just like Jerry said, and you also want to get a sense of what they appreciate in terms of communication ability. I can certainly volunteer that I've worked for a number of different PMs, and they're all hedge fund portfolio managers. They all went up from analyst to senior analyst and made it to portfolio manager. They have the chops, they have what it takes. If you put the same set of data in front of each of them, they might each have a different take on what to do with that stock. It could be determined by, their catalyst path, their ideal investment duration or timeline, or their inclination or disinclination for quality or, junk. Just it can vary. And that's not something that you can know from the outset. I'm going to throw a slide up here. We'll get a little bit into, so this is a little bit of 2 ideas, but I don't think there's such a thing as recruiting without pitches. They're your price of admission to an interview to show that you do the work And you might say, well, why can't I just go work there and then do the work? Well, this job is all about doing pitches all the time. And so it doesn't really make sense to hire you and then figure out if it makes sense if you do it in a way that works for them. And also, I know of a case where there was somebody who did something adjacent to the hedge fund analyst role and through sheer chance and circumstance wound up interviewing with a place that was eager to deploy capital. And the the interview process didn't really include a full-fledged case study because the firm was very eager to get up and off the ground and build the team and deploy capital. And so in that instance, the interview process never contained an actual case study for a stock. Now, you might feel like, well, it's a good thing though, because you get hired to work at a hedge fund. But if you find that the way that you analyze things, the way you communicate your findings, even the things that you think are interesting to look at, compared to what your PM's preferences are like oil and water, you might not last very long at that fund because there's a way you do things, there's a way the PM does things, and there's no tiebreaker point. All ties go in favor of the PM. And so, some people might wind up in a seat without getting a real sense of discussing, the merits of a pitch. And so there's a reason I mentioned that, which is hedge funds will often do case studies. And so if you're getting a case study, you pass the airport test. Okay. They never give a case study. I can't think of a case I've ever heard of where a fund was not even considering hiring somebody and they gave them a case study. So, if you go through the screening and, whether it's the headhunter or business development or a member of the team looks at your CV, they say you're interesting on paper. This is where you start to chat with each other. And so you might talk with the PM or somebody at the team, and this is where you might be asked to give a pitch. And this is where you can talk about an idea, something you've been working on or something that you think is interesting. We're going to get a little bit into how to really distinguish yourself by researching your audience. But this is where your pitches come up. And then when you get to the case study and you have a debrief, this is really the pivotal point. To even make it into the funnel is difficult, but to get to the case, they're seriously considering you as a member of the team. And so what separates the people who are on the short list or maybe in the top 3 versus the person who ultimately gets the offer? I would contend that it's the person who has demonstrated that their method of analysis, maybe the repeatability of it, maybe the way they prioritize how they communicate, these are compatible with what the PM is expecting. Now, to be fair, the PM is not in all cases looking for their personal clone to go run and do things. Sometimes, if you do everything the PM does, then your ability to kind of debate ideas is limited. What they're looking for is somebody who's a fact finder, an independent thinker, just somebody who gets to the bottom of things, someone who's curious, hungry, humble. These are all very important traits to have. And so when you're doing a case for a PM, what you want to establish is a common reference point where you can say, hello, PM, I have taken a week to look at this ticker, which you have assigned me. Here is the work that I have done. Here are the analyses I've done. Here's my conclusion. And if I had, 2 more days, here are the things that I didn't get to, but that I would have put in this. That can be kind of a standard textbook debrief with a PM. And in that, you'll be challenged on your analyses. Why did you think that this was the key driver and not that? And it's not meant to yell at you or something like that. It's truly just an objective question to say, can you talk a little bit about how you zeroed in on it? In fact, there are some PMs that people work for where you don't know if they're long or short the stock when they're talking with you, and they're not trying to in any way nudge or bias you in any direction. They just want a download of the thoughts that you had in the process of completing your pitch. Jerry, have you in your work in talking with people, What are some things? What have been some interesting anecdotes that might have come up when people have been going through a case study or had a debrief with a case study? Are there any that come to mind?
Oh, I can talk about my own as well because as
I'm sure
you brought
there.
up the point about uh you brought up it's really funny because you brought up the point about you don't know the PM is long or short. So in the case study for which I got the offer for the hedge fund I used to work at for so it was a two-round case interview. One round was a 3 day case over the weekend. So I literally spent yeah, I say a lot of time in it. And then the second, the final round was a timed 4 hour case study, which is kind of like the fidelity P test, but extended to like 4 hours. And it's funny, it was a pretty quality company, and because I had a preconceived bias because I talked to these wide mode long onlys who own this name, and I pitch it as a long after my like quick dive, and I put together like run the numbers and say okay, I think that's a long, despite it's a very cyclical, the end market is it's sort of an industrial name. And when I joined the firm, I look at their portfolio, and it was one of the bigger short positions. So I think one of the things to remember is like Andrew said, it's not necessarily you need to do something to conform to the PM or the senior member's view, or even the process. It's that you want to demonstrate you have a process to argue based on the facts you found and based on the reasoning that came out of the experience you've had doing this on your own or in prior jobs. As long as you can communicate your reasoning, and especially in shorting, which I'm wildly inexperienced at, especially in shorting, the saying is if you can definitively refute the bull thesis, there is something there. It's at most a pass. It's and most of the time there is something um actionable on the short as you can ascertain the catalyst. So despite pitching a view of a completely opposite of their high conviction short, I got the job. So that would be one story. But yeah, I mean, I think some of it is just like most of the time the situation I've heard is like they just there's not enough mixing of narrative, the qualitative, and the numbers. It's either there's too much. Hey, it's a good business. I'm telling you, selling house online, like i.e. open door, selling house online is that's a secular trend. I'm telling you, like we need to buy this. And you look at, but they didn't have a sense of okay, well at $20 a share, what's the embedded expectation of long-term earning power of this business? You telling me 10 years out it can, but they didn't have, well, some of the candidates didn't have even a framework of, including myself when I work at a hedge fund. Until I saw Brett's tweet about normalized earning power, I didn't know like that framework of kind of okay, 10 years out, this is what percent of the market it can capture. What's the steady state incremental contribution margin and operating margin it can earn, and as a result, what is its earning power, and on a normalized multiple, what is that stock? Oh, no way we can get to $20. So yes, I get it. It's a secular trend, but that might not even be true either. But like just on that point alone, right? That's a bad pitch as a result. But on the other side is you see this a lot on like certain forums or certain like stock related apps, right? You have these like contributors, they they lay out, it's kind of like a download from like a chat GPT when you feed it a earning report. Like they tell you okay, uh expenses went up less quickly than revenue, and as a result margin expanded. Thanks, right? Like you didn't tell me on a forward basis what's gonna happen, and like that there's there's not much there, right? So a good pitch clearly talks about what your variant view is on the business driver, and it comes down to the things that you guys talk about on your courses, which is okay, revenue, like growth, margin, operating capital intensity or capex intensity, working capital, and all that stuff, right? So you didn't talk about what your variant view on these things are, no matter how great the business is. I mean, that I'm not. There's no action there, right? And so yeah, I think marrying uh the qualitative with the quantitative, the best pitches can do that, and they always lay it up front, right? Versus okay, like when I someone do mock pitch with me and I say, okay, thesis number one, this is a great business. I'm like, okay, I know where this is going, right? So yeah, I think, and the other thing is there's insistence on complexity. The saying is there is no extra alpha. There's no extra alpha. There might be alpha. There's no extra alpha on a complex situation. You tell, oh, I'm pitching this like really obscure defense name that's something about like satellite in operating like some mega 300 megahertz spectrum. I'm like, bro, like I'm already gone. Like this like maybe I'm if I'm a tech geek, maybe I'm even I'm interested, but this takes a lot, and all it takes is you pitching to a generalist PM or a PM that's not well versed in that stuff to say, okay, maybe this is actionable, but do you have something that's more understandable, right? So and the sad reality is trying to get the job sometimes doesn't have much to do with having a great idea. So you need an idea that gets you the job first. So why picking a high hurdle when there's a low hanging fruit that's clearly a very simple thesis, maybe even just two theses, or even sometimes just one thesis that one thing that you have a variant view on, and as long as that variant view turns out to be correct, the stock will move. But why not just go with that, right? There's no point in going with complexity or sum of parts and all that stuff. So yeah, these are the things I've heard that yeah, like clearly is people who don't know what the getting the job game is, like they tend to make that kind of mistakes. Yeah.
You make a great point. We try and one of the things we talk about is how pitching is a little bit of a different skill set than analyzing a business or understanding a company. And it's true, a lot of new analysts, they want to show that they've done a lot of work, they've covered a lot of ground, they've turned over every rock, shined a flashlight everywhere that they can, and then what they give you is the output of that exercise. But that's a backward looking exercise or maybe a snapshot of where things are right now. That's usually what I'll say in working with people who pitch things like that is you have provided a rear view mirror. What the PM wants to see is the windshield. Where are things going? What does the forward look like? And
I
so
like the analogy, by the way.
copyright Andrew Carr 2024.
TM,
So yeah,
TM.
so the but what it does is it is not to say ignore all of the base facts about the business. In fact, your thesis, your variant view is only going to be credible in proportion to your understanding of the business. Now, you can call a secular trend, sure. What might be harder to do is, like Jerry was saying, tying the quantitative to the qualitative. You know, a lot of stock pitches are kind of separate tracks of numbers and narrative with no connection between them, where you're just making statements about the company, but without saying something about how the numbers change. So, for example, recently I've seen some pitches, like let's say Nike. So there's a little bit of a debate with Nike about what the China business forward outlook looks like. Well, okay, Nike discloses the revenue by geography. So if you're making a pitch on Nike, I would expect that if you were expressing a view about the China business and the future growth trajectory, I should be able to see that in the model. Like, what do you have growth accelerating or decelerating, and where does that put your segment level revenue versus consensus, and where does that put your total company revenue versus consensus? That is what's good for the PM is they can isolate what it is that you are saying, and then they may say, well, this growth rate implies a growth rate of this many dollars. How much is a pair of shoes, or how much is a pair? You can narrow it down to the specific drivers, the inputs of that segment. Compare that to a pitch that just has total company revenue, And then the write-up says, oh, what happens in China is going to determine the trajectory of the entire Nike stock. Well, where can I see that in the model? Where can the PM see that in the model? And uh, it's a little bit of an exercise that I give to people who are new to pitching stocks sometimes. But I say, just imagine that for the first 5 times or so that you try and articulate something, someone's going to say, that's not true. That's already in the stock. There's no way that's true. You're wrong. You're thinking about it wrong. You haven't done enough research. And it's very frustrating and maddening because you're doing all this work. But the net result is you can advance your work to a point where you say, I don't care if you've looked at Nike for 20 years or 20 seconds. This is where the delta in the numbers is. This is what my analysis shows. And that's all the PM wants to see. And there doesn't need to be a whole emotional production. I worked tirelessly through the night. I haven't showered in 6 days. I needed to get this case study done. And it was my number one priority. It's not about all of that. It's just at the end of this exercise, did you pop out something where the PM understands what you're playing for? Because the flip side of that is if what you're playing for doesn't materialize, how quickly will you be to react to pull the plug on your pitch? We are in the stock because of A, B, C. So if something happens and suddenly thesis B evaporates or thesis C is now impossible, are you going to exercise adherence to the thesis? Because remember, the hedge funds only begin with stock pitches. After the name goes in the book, that's when it can influence the total hedge fund P&L. So that's when you have to pay extra attention to the stock.
Yeah, I mean, this is a digression, but this is a great point just to step back on the general mistakes that candidates have about this profession. And I don't want to tie into the insane amount of biotech sell-side equity research job opening that I've seen this year. Just doing my job board is I get candidates who come to me. They're like, oh, I have a PhD. I'm doing research at like Wine Cornell. I'm with like some cancer drugs. Like I can read scientific papers, and then the first thing I say to them is, yeah, I think I cannot read a cancer paper, like cancer research paper. Like I can never do because I didn't even take biology in college. I was a math and physics guy. But you're missing the point. The point is, like Andrew said, the most valuable thing you provide as a junior and senior analyst and as a PM, but PM has extra responsibility. The most important thing is, can you? I'm not. We're not in the business of researching companies. And let me finish. Researching company is kind of the table stake. We're in the business of making decisions. You have to tell me what the hell I need to do with when I tell you to go like dig up this company. Yes, you told me all the historical fact. What does it mean? What are we gonna do? Are we gonna buy this stock? Don't do anything, or are we gonna short the stock? Or are we, if we were already long, are we gonna sell the stock? So yes, reading scientific paper is great, but there are always gonna be more people who can read scientific paper than people who read the scientific paper and ascertain which of these small cap biotech company are actually gonna successfully get to FDA and have commercialized pipeline of drugs. That's the business where the business value, and that's when the stock's gonna move, right? So and so people need to get rid of that misconception. Oh, I want to be in this industry to trade stocks. That's not what this job is. Like the trading stocks has to be related to the underlying fundamental of the business. But the other side is equally dangerous, which is, oh, I want to be a investor because I love researching businesses. And unfortunately, yes, you can do that as like a, I don't know, management consultant or what I do as a blogger, and you can do that. But the investing, you have to take it to the next level, which is like you have to research the company and you have to tell the people you work for, what do we do with the stock? And sadly, you can do research for, like Andrew said, you can do research when you know what matters. You do research for, okay, like Ricky Sandler recently did a podcast with Ted Seides. He talked about they were long. I don't know that they're still long. They're long Dave and Buster, and all they are tracking is alternative data on the 10 stores that of the 200 stores that are going through remodel. And so they slice, and that's their thesis. If they're gonna reaccelerate growth, those 10 remodels are working, and they have alternative data to track that. If the data is telling me it's not working, thesis breaks down. That's all it matters. But of course, Ricky is really experienced, so he's telling us what matters, right? But so that's the point, is that if you know what matters, sad reality is your performance is solely judged on the output of your it's solely judged on your recommendation, not on how many hours you do the research, right? So people need to be aware that all the input to the output is how hard you work to dig and to over time seeing enough pattern recognition to drive quality output. But you only judge on your output, and that's really brutal. But you need to be aware that's the career you're signing up for. And so that's the point I wanted to make on the conversation you were making.
Yeah, no, it's a good one. I mean, people say, I worked really hard on this, as if everybody else in the investment management industry is like a bunch of Sims who don't do any work. It just doesn't add up. And so, yeah, in terms of being able to communicate succinctly what matters, the Ricky Sandler example is a great example. When you're trying to pitch a stock, it is probably true that you can make a judgment about the future makeup of the ocean ecosystem by studying the concentrations of certain minerals in the ocean vents at the bottom of the ocean floor. That's probably true. The business of investment management is unrelated to that. It's where can I find fish today? So it's true. The bottom of the ocean, maybe over the long term, these things will change. But when you're pitching a stock, you're pointing at where the fish are. And what you're doing is you're laying out what the market has misunderstood about this company. And that's, I think, another thing where people think about consensus. When people are new to pitching stocks, they may see that an analyst from this or that, household name brand bank has a buy rating. And they say, well, surely, either they'll say, I should buy it because that analyst says it's a buy, or there isn't a buying opportunity anymore because people have already figured it out. Well, at the end of it, something I walk people through is I say, all right, have you ever checked the weather on your phone? Most people have. Have you ever seen the weather forecast say one thing, like it's going to be sunny out, and then you walk outside and you got completely soaked by the rain? And, the weather was wrong, though. The forecast was wrong. Even though the weather forecast was wrong, I bet, number one, you didn't delete the weather app off of your phone. And number two, I bet you that after that event, you still checked that same app that is known to not get it right all the time. Why? To know what the weather is going to be, even though you know that's not going to be it. So think about consensus as if you took the average of your iPhone weather app, local TV station weather forecast, Android weather app, weather.com, whatever you want. You take the average of that, and that's just the baseline of expectations. Now, there's a reasonable basis probably for how those numbers got there, but you shouldn't treat them as infallible. You should treat them as the reference point. And the reason why that's so important is you need to understand that the reference point is fallible, and you need to know that so that you can articulate a variant view. If you walk into a room and you're pitching a stock and you say, let me tell you what the market is missing on this stock, the PM is going to say, okay, is the market getting the multiple wrong? And what multiple should this stock trade at, and where does it trade right now? You might say, oh, the stock trades 25 times. And I actually think 25 times is about right for this kind of stock. PM says, okay, then your delta's got to be on revenue or on EPS. So what do you have for me there? It says, well, I don't actually have that much delta on the revenue or EPS. Well, the PM is going to conclude that sounds like, rather than misunderstanding anything, the market's got this one all figured out. There's no alpha here. There's no different multiple. There's no difference versus consensus on the metric, the forecast metric, whether it's EPS or EBITDA or revenue. So there's nothing to do here. Now, does that mean you didn't work on the company? Doesn't mean that necessarily. It just means that you've done this work, and based on what you have done so far, it seems like this one is pretty well understood. And so when you're thinking about pitching a stock, you want to be able to lay out, you want to be able to quantify what the market is missing. And different people look for different things that the market is missing. Um, and so maybe that's a good tee up into the kind of, if you put so much work into your stock pitches and you try to learn everything about the company, you read the 10K, the 10Q, the earnings releases, investor day presentation, find as much as you can from the filings and all the statements from the companies. In a little bit, we're going to get into, answering the question, wouldn't it be nice if hedge funds had 10Ks that you could read and learn all about the fund and how they do what they do? What do you think, Jerry?
Oh man, this is getting to this is probably not as well broadcasted as before the rise of fundamental edge and I guess Richard Toll. So, so I remember this because when I was in MBA, when I was in business school, I did a school year internship, a second year full year at a Manhattan-based a deep value hedge fund. And my first round of interview, I came in, and this ties into the point Andrew tried to steer me into. I didn't know that document existed, so I went in and talked to the head of IR, who also served as the COO, HR, and I spoke with him. He said, and Joe and this gentleman Joe's Jerry, have you heard of this Form ADV? All hedge funds file this document. I'm like, what is Form ADV? He said, yeah, don't worry. So before you meet Matt and Doug for the next round, who are the two analysts working for the founder, before you meet Matt and Doug, just read our Form ADV Part 2. Trust me, you come in, you're very passionate about stocks, but trust me, you'll come in very, very well versed about how we do it here at this hedge fund. So I read it. Oh my God, I didn't know all these hedge funds actually file this seemingly boilerplate, but in reality, most funds actually do add in very juicy information, and some of which definitely get you aspiring hedge funders like salivating, which is they actually talk about things like, okay, where's our headquarter? What is the email address format our fund, right? You want to stalk the founder, like shoot out a networking 5 minute email, right? You want to get a coffee chat. They show you Lone Pine Capital, they show you their office, they show you their firm email format. They tell you who are the founder, where do they have offices, this is the juicy part. What is their fee structure? What kind of product they offer? And the most important thing I think is section 8. Section 8 is where they talk about what's their philosophy, what's their process of investing. Of course, some of them are not that insightful. They tell you we're private equity approach to the public market, blah yada yada yada. But most of them actually they tell you, okay, we are a uh, growth at a reasonable price fund specializing with a sector bias toward healthcare. I recently wrote about Glenview, and that's what they are, right? So these are the things, and so that's a very valuable document. So Form ADV, you can go to the IAPD website. You can search for the funds that you want to do homework about, and there's a wealth of information that you can learn up. And these are table stakes. These are bare minimum when you go into a conversation and really helps you stand out versus someone who just goes in. But you can even go a little bit further. So we talk about part two, which is part two is a document. Part one is a form. So part one actually has a lot of in useful insight too. They tell you the gross asset, which is unfortunately not as useful as you think because it's not true AUM if the firm is levered, but still they tell you kind of you can get it. Okay, you assume they adopt a industry standard like leverage versus like multi-manager, like you can kind of back out roughly what the AUM. It's not accurate, but they also tell you how many investment people are there, like how many assets they manage, and what is the like who are the partners of the fund, and are they going through any legal trouble? I think you should know that, right? You don't want to be in someone that's like being litigated by regulators or by a competitor or by one of the partner, like infighting within the hedge fund, like those stuff happen all the time, right? But so that will be one piece that really kind of puts you slightly leg up. But on top of it, because all of us these internet-based people exist today, like creators or internet-based kind of coaching businesses exist, uh, there's no excuse. there's so many podcasts out there who are trying to outcompete each other for listenership. As a result, you're getting free access to all these great investors. Like they just go on these podcasts. Like we just talk about Ricky Sandler. Like Brett has a curated list of different style investors. Those are tables that you got to listen to those when you go in to have a conversation with funds with people who work at these funds that you're interested in, right? So the more work you do, the more respect you're portraying, you're showing. You don't have to actually respect them, but you're portraying your respect for these firms, and that really puts you in a greater position in terms of likability and a preview of your diligence skill, right? As a investor, and that just puts you that all helps you as a candidate, right? I'll
Yeah,
stop here. Yeah.
the signal value in doing that is really something. Sometimes people say if I had more time, I would read two more earnings calls. Uh, what Jerry's saying, which I would agree with, is instead of reading earnings calls 5, 6, 7 after the 4 you've already read, in the time it takes you to read one earnings call, you can pull up Section 8 of the Form ADV Part 2 brochure and learn about the fund. Whatever incremental was going to be in that earnings call is probably eclipsed by what you can get learning about your audience at the fund. Because when you have that interview, chances are they're not going to say, did you happen to see what they said 5 earnings calls ago? But what you can do is, number one, signal that you do your homework. If the information's out there, you can find it. And this one's not even that hard to find. And then number two, it can help you tee up your conversation, because here's another thing I see with people who are pitching stocks and they're new to doing them. And this can happen a little bit even with case studies. They may reach one conclusion or another about the stock. Now, if it's your own personal pitch, look, you found what you did with what you could. Hopefully it's a company that's easy to explain. So the debate isn't, what does this company even do? I'm lost. It's, oh, you said that there are going to be more orders than consensus has. Why do you believe that? Have you done any work that would suggest that there is this upside? It's a much more focused conversation, and it allows you to go into a conversation with a fund where, let's say you're talking to a healthcare fund, but your pitch is in consumer. Now, hopefully you know that they're a healthcare fund before you go in the door, but you can take it a step further. You can say, well, I have a pitch here, and credit goes to our Fundamental Edge colleague, Paul Johnson, for this one. A way to bring the PM to your side is not to come in and say, hey, here's this pitch, you got to buy this stock. Don't do that. You don't know exactly what their portfolio is or even what it needs right now. Instead, what you say is, I understand this is a little bit different than what you do. This is a pitch that gives you an example of how I do work. And so the PM is no longer thinking, oh, well, we already have a name that's substantially similar to that and has better prospective IRR. Your name is never going in the book. They're in defense mode, because you need to be as a decision maker, as a PM, you need to be evaluating the merits of things as you are exposed to information. Here, you're dropping the defenses, because you're just saying, this is really just me doing analysis and communicating my findings. And so then
I love it.
the PM is not going to, pat you on the back and say, all right, let's crank on this together. But they are going to at least say, okay, well, let me hear out this person pitching the stock. With the Form ADV Part 2 brochure, you can say, I understand from how the firm invests that generally, the power alley of the fund tends to be, it could be, well, for like Eminence, the firm writes in their form that they like to invest in quality value. So quality stocks that for some reason or another have become dislocated. And maybe the way that you can pitch a stock that will be more interesting to somebody in that kind of setup is to say, here's a great company that has this headwind right now. Here's where I think that headwind is going to go away. And I think that's what's going to drive the stock back up. Now, that's very different from saying, here's a company that's 6 times levered, terminal value is 0, short interest is 40%, but it's gaining a lot of momentum on various message boards. And I think they are actually going to beat consensus KPIs into the print. That's the funny thing. You could actually be right. That stock could be up 20, 30% on earnings. However, at the type of fund that you're talking to, that's just not something they're ever going to put $1 behind. And so showing that you know that is a big one. And there's another overlay that you can do. Jerry, do you have something to add?
No, I did it. Yeah, actually, that's it's exactly along the line as well. It's like don't make rookie mistake because you didn't know that information. Like I've read enough Form ADVs to know. Like they tell you, okay, we don't get involving names like below 1 billion cap. What are you going with a 500 million cap name, right? With like low trading, like 40% owner like owned by the founders or like by the family, right? These are right. That's kind of like the
Yeah,
when you do Jeopardy, that's you're not getting a
yeah.
point, right? So yeah, so totally, yeah, on your point there.
Now here's another thing you can do. So we talked about one of the more esoteric forms that has information about a hedge fund, but there's one that's a little bit easier to find, and this is a regulatory filing called the 13F, where the fund says the kinds of things that they're long. Well, there isn't just one 13F permanently. They come out quarterly, and you can see actually, is there something that's new in the 13F? Or is there something that they used to own a lot of that I looked in the new one, I don't see it there anymore. And now it's not going to give you the shorts. You're just going to get kind of the long. So that's important to understand. But when you look at the 13F, you can see you can evaluate when did the fund buy this. If you look at the historical ownership analysis, like did they buy a stock and they could sell whenever they want because they've already made so much money on it, and so now the question is like, why haven't they sold? Is there some more value in the stock that they're playing for? But think of the wealth of information that you get. This is really one of these 1+1 is greater than two situations, because if you know how the fund invests, and then you can kind of see some of their cards out on the table of where they actually risked real investor capital. This is incredibly informative as to whether I'll give you an example. If they say, we tend to prefer stocks that fit parameters XYZ, you look at the 13F, it is at best 70% that, 30% things that in no conceivable way could they fit that mandate. Now you know that they're a little bit flexible with regard to how they invest relative to what they put in their Form ADV. In that case, if you walk in, you can say, now I know that traditionally you tend to have this type of philosophy, but I see in your 13F that sometimes, opportunistically, there might be names that don't exactly fit that profile, but could provide an interesting source of upside. Here's my pitch. And it doesn't even have to be the main thing. And now they know it's, markets are funny in this way, but it's not just that you know something or someone else knows something. It's a lot of the you know that I know that you know that I know that
Yeah.
happens in markets. And so there's immense signal value in that. What are some other things in 13Fs that you've seen along the way?
Yeah, I mean, I think yeah, the whole jockey stock is a real thing. I definitely do that, but I do so uh even in the long only world, the equivalent will be where I taught my clients in the course, which is leveraging the Morningstar filing, where they aggregate the mutual fund filings and mutual fund not mutual funds are not all necessarily slower turnover. So generally, there's more signal value in concentrated low turnover investment strategy in both mutual fund, in which is a Morningstar or a 13F for a hedge funds. Um, and so yeah, jockey like kind of looking at the investor you admire and see, oh my God, like they just took a big position like Walgreens, right? Oh, well, what is going on there, right? And so but like you said, one of the challenges is the shorts. You don't see the shorts. So you gotta be careful with situations where these funds are coming from certain lineage where they like to fund their high velocity shorts via like a concentrated like 8 to 10 names of like compounder longs. So you might you might go into say, hey, I want to work for you guys. You guys seem pretty chill, like deep dive for like 2 months and take put 10% of your exposure in like these longs. And this is a place I want to work. And then and you didn't do your homework and you didn't know how it was. Oh my God, on a quarterly basis, the junior is just sitting there stressing out about the 10 shorts they put on going to the quarter, like every quarter, right? So you these kind of situation, it becomes really hard to know without you doing your always augment the things that Andrew and I are talking about with your primary search of like the people know each other in this industry, right? Ask her, oh my God, like this is a XYZ cub, and they tend to like compounder longs and then high velocity catalyst shorts. Like they do that, they turn over the book. They actually high turnover strategy. And so you know that from first principle because chances are they might not even tell you that from their Form ADV part two or going on any podcast and highlight that kind of stuff. And so yeah, that would be another. And then the other thing I guess is this has happened from personally. I've gotten stories about for people that either stress them out so much during COVID or they burn out so much during COVID that they leave is the risk of style drift. So you look at 13F, like Andrew talked about. One way is looking at how quickly positions turn over, but also you look at uh, how their sector exposure has changed over time. Like their sector mix of their portfolio has changed over time. Because I can tell you for sure, I've heard that personally from a few close buddies is that their shops lost their North Star during COVID, where the market regime has changed things. In hindsight, who the hell knew all these like home goods like Home Depot and people start doing remodel. In hindsight, it goes really obvious if you walk around the street, all these people doing remodeling you with their contractors. But as a result, right, like the TMT, like let's say a TMT shop used to be a compounder shop. Suddenly you look at their 13F like June 2020 or September 2020. So all these like mining names, right? Because all these secular like copper trends, because of EV trend, and vice versa. All these like old economy, traditional old economy, deep valley shop. They're like, oh my God. Like look, they get envious of like all the Tiger Cubs putting up number in 2020. In 2021, you look at their portfolios, own these like deep tech. Like you ask them what does like some semiconductor company do, we have no idea. They and then you know the old material like investors they are talking end markets. Oh yeah, these are end markets, right? This end market is growing. I don't know what how they're technologically differentiated. They don't know the devil is in the detail, right? So it gives you a sense of like okay, do they actually stick to the way they invest, right? So all these things are, if you are so passionate about learning about different hedge funds and how they actually do things, right? These are signals that can be red flag that you can avoid when you make your career decision, right? Things like that is yeah, there's some signal there's obviously people know even in the CFA exam. I think it's in the CFA exam they warn you about uh because there are these quarterly filings. There's this concept of window dressing, right? Which is they want to portray certain things to the general public or also try to hide investment signal from their competitor, right? So at the like toward the end of the quarter when they need to file, because remember these 13Fs are like balance sheet, they're a snapshot. It's not a cumulative thing during what happened during the quarter, so they can trade it out and then trade it back in after they file, right? So be aware of. But in general, the longer term oriented funds, they don't tend to do that versus the funds that get tactical about these kind of things. But again, you look at these filings, that's all factual, legal stuff, but you have to augment that with words of mouth about, oh, that 13F filer, I know they window dress, right? Then okay, there's not as much information signal, right? So things like that is where you can get really resourceful and come into a conversation being very liked by the founder. And remember, these are all very, very small businesses. Like hedge funds are small businesses. These founders are all have big personality and they care about the legacy they've built as a founder. Because the reason why the people start hedge funds is because they have a belief of investing a certain way that didn't align with their prior employer, right? So and the more you can flex to that, the more you can target to their liking, to pitch it to their way of to pitch to their vision of how they want to do things, the more you're going to be liked. And yes, ultimately, I still believe the most important thing is your ability to put up numbers to generate return. But you never know, your likability might just, when you have two competing candidates who are equally good on the investing side, you never know, just because you flex it a little bit more on the liking side, it might just tip over the scale to your favor, and you'll be the chosen one. And remember, most of these funds, they don't hire very often. So if you get the spot, the rest is history. We don't need to
Yeah.
have this conversation anymore, right? So something to keep in mind as well.
It's a great point. The only time I think 13Fs might have negative or zero information value is if somebody's getting ready to, and it has to do with the window dressing. If someone's getting ready to have a conversation with one of the multi-managers, there is no informational value in how many shares were owned by whichever large multi-manager firm you're thinking of. And actually, even if that information were correct, what you don't know, remember, the shorts aren't there. So you could have some teams that are long a lot of some company's stock and other teams that are short that same stock, and they work under the
Yeah,
same umbrella. And
yeah.
so on
You're neutral.
The 13F, it looks
Yeah,
like they own like 3 shares of the company when actually they have billions of dollars of exposure to the
exposure.
company.
Yeah,
So
yeah.
you can't know from looking at that. But yeah, outside of the multi-managers, the 13F is an amazing overlay. And for those looking to, reach out, you think about a Form ADV Part 2 brochure, you're looking at the 13F. If you're reaching out to a fund and trying to be scrappy and try to find a job, if you've got a pitch that you think aligns with how they invest and you've never seen it in the 13F, compare and contrast. Hello, I would like a job. Hello, I have a pitch of something that I think tracks with your investment style that I read about in your Form ADV Part 2 brochure. Also, I have never seen this name in your 13F. Would you like to spend 5 minutes discussing it? It would seem to me that this one probably is likelier to get a positive response from the fund than this one. And
Yeah,
that
actually, that's a great point you brought up. I wanted to add a point
yeah,
about the multi-managers, which is the issue of commingling, right? Because multi-managers are there are thousands of individual portfolios run by individual portfolio manager. And that's the same thing with when you look at the 13F of a mutual fund, or a 13F of a hedge funds. Nowadays, hedge funds are all also offer multiple products. They offer it, like, so again, back to the actually kind of giving away my what I write about this week. Like Ricky Sandler talk about like Eminence today is mostly is more long only than long short. Like their core long short portfolio is like 40% of their AUM, right? So so in that case it's fine, because what hedge funds will do for their long only product is they just scale up the long book of their long short into a long only product, or they also have a 150/50 product. It's the same thing, just keeping the net exposure at 100% and scale up the longs and scale up the shorts. But in a multi-manager, precisely on Andrew's point, it becomes challenging because, I want to work for Andrew Carr, who works at this pod shop. I work for his pod. Just you can't tell what he owns until you tell me what you own, right? Because I don't know what, like, the multi-manager as a platform owns. Like, I don't actually, I take that back. I know what the multi-manager platform owns, but I don't know what you own, right? So there's all these nuances you got to be aware of. And same thing with mutual funds. A big mutual fund company like Wellington Management, they have growth and value products. And when you look at the 13A, they just roll them up together, right? So it's a lot. Okay, are they, unless you are, it's a single style bias long only, there's not much informational value on the 13 app. You can look. So Morningstar actually does show you the individualize on a product level, like, okay, Wellington, making this a Wellington Growth Fund Alpha, right? That you can look at the portfolio level. Okay, that actually tells you, okay, they're sizing up like NVIDIA deciding down ASML, and there's no value name in there because the value portfolio has a separate Morningstar entry. So these kind of things are where there's some nuance you gotta pay. Yeah, you can't just look at a 13F and see informational value that way based on the firm. Yeah. Yeah, but there's a lot of art to that. That's the general takeaway.
To be sure, there's a lot of art and Jerry, you've provided a lot of nuggets for people to think about as they get ready for their buy side career. If people want to learn more from you and about the different things, I know you write about funds, you write about life on the job. Where can people find you to learn more?
Oh, no, so in general, the easiest way, because I know you guys want to save time. The easiest way is actually just search for Richard Toad, the name itself. I'm everywhere. But if you want a centralized funnel to see the resources free and paid, I know you prefer free, is go to www.richardtoad.com, and that at that place you can I'm an Instagrammer. I am a sort of a YouTuber, but I'm more proud of my blogging work. So yeah, where all my publish content on career and funds are there. And so yeah, just go to www.richardtoe.com and you will find all my presences. And you can go from there and see my takes on different kinds of things related to sell side and buy side equity research. Mm.
Fabulous. Well,
Yeah.
it's tremendous. So I think we'll wrap it up there. But and for those who want to learn what you do after day one in the seat, I'd welcome you to enroll in one of our upcoming cohorts here at Fundamental Edge.
I enrolled, so I can tell you so far not so good. So far so great. Yeah.
Oh, thank you
Yeah.
for the kind words.
Yeah.
All right, we'll wrap it up there.